Hi everyone, this is Madan Ravindran. In this video, I'm going to explain why the spot and the future prices are not the same. So the spot price which I'm here referring to is nothing but the current market price of an index or a stock, which can be bought or sold for immediate delivery. So have you ever wondered why future prices are sometimes higher or lower than the spot prices? In this video, we'll be breaking down the key reasons behind these price movements and how they reflect the market sentiments. When we say the spot and the future prices are not the same, which means either the future price can be lower than the spot price or it can be higher than the spot price. When the future price is greater than the spot price, we can say that the future is trading at a premium. So why is that so? Because of one among these reasons. One can be cost of carry. So cost of carry is nothing but the extra cost of holding those future contracts instead of buying the asset directly. So it basically includes financial costs. Financial cost here nothing but the interest on which the amount has been borrowed. So that is a financial cost. So I'll give you a real-time example. Suppose take for example the Nifty current spot price is around 25,000 rupees. So financial cost, which is interest on the borrowed money, so consider 8% annual return. So if you see for the 25,000, 8% will comes roughly around 2,000 rupees per year. And say for example you are buying a monthly contract, which is basically the expiry is 1 month. So just divide this 2,000 by 12. So it will be roughly around 1,600 rupees. Okay, so 170 rupees, sorry, I'm sorry, I thought it's just 160. So it is basically 170 rupees. So for 1 month it will be around 170 rupees, which means the spot price is 25,000 rupees plus the interest comes around 170. So now the future price may trade at the price of 25,170. So here, as per this example, the spot price is 25,000, but the actual price is 25,170. That 170 premium is nothing but the cost of carry. So the cost of carry has a impact over here. And another one reason could be it can be a positive market sentiment as well. When the trader is expecting the underlying assets price to rise, so they will be willing to pay a premium for the futures contract. This is also a kind of a indicator of a bullish expectation. So say for example currently Nifty spot price is at 25,000, and so we suddenly get some macro news saying that the government announces a major economic reform which will expect to boost the corporate earnings and the economic growth. So in this case people expect the all the stocks or the underlying index to move up. So because of this they are willing to pay a premium extra. So even though if it is 25,000, so they may willing to pay little more than that, expecting market to go up. This is a kind of a bullish expectations. And so because of this the demand for those future contracts will increase. So the traders wants to lock in the current price expecting it to rise further. So this will increase the demand and pushes the Nifty price to go even further above than the spot price. So it all depends on the market sentiment and high interest rates as well. So suppose this is also one among the reason why it may trade at why the future price may trade at a premium. Suppose the interest rates raised from 8% from 6%. So basically the investors who was expecting a higher returns from income tax, fixed income assets, so they may shift their investments away from the equities, expecting a better returns in safer investments like FD or anything else other than the equities. So in this case, Nifty Futures trading at a premium during high interest rates may indicate that investors are very optimistic about future economic conditions despite the higher interest rate, despite the higher borrowing costs. So this premium also reflects the kind of demand that we have for the equities because of the expectations we have for the corporate earnings or the economic growth. So to basically outweigh the negative impact of the high interest rates. So these are all the positive reasons things may be. So because of these positive reasons, the Nifty may trade at a premium. And so futures trading at a discount. So we can say that the futures trading at the discount price, when a future contract trades at the discount, when the future price is lower than the spot price. So then we can say that the futures trading at a discount. So this could be again due to below reasons. It's kind of opposite of futures trading at a premium. So here there over there people have expected a positive return. So here when the market people are expecting a negative price movement, so when traders anticipate that the price of the asset or the index may fall because of this negative news or some slow economic growth or any other news, then futures price may trade at a discount less than the spot price. And another reason could be dividend adjustments as well. So when dividends are expected during the holding of an index or a stock future, the future price will be adjusted by subtracting the expected dividend amount that you get from the spot price. So say for example, you have an Infosys stock which is trading roughly around 2000 rupees, and you are expecting a dividend of around 100 rupees, then the future price would be like 2000 minus 100, which will be a 1900. This is because the future buyer will not receive the dividends, so because of this the future prices will get adjusted accordingly. So this could be one among the reason why Nifty futures in general futures trading at a discount price. And the short term market volatility as well, when there is a lot of volatile in the market, the futures may trade at a discount because of the higher risk that is involved in the short term. So this could be also one among the reason. Yeah, so the why does the premium or the discount change daily? So if you see the difference between the spot and the future price every day, if this is for somebody who is tracking it, you will see some difference almost every day. Some day it may trade at 200 rupees more than the current price, or 300 rupees more than. Sometimes it may be minus 100. So if you see, this may vary almost every single day. So some day it will trade much more than that. So it's because of these reasons, like I have explained before, market sentiments, interest rate change, or the dividend announcements, and even the supply and demand. So suppose so say for example, today all of a sudden a large institutional investor suddenly buys a large amount of uh, HDFC Bank futures contracts, which is basically a hedge against their holdings. Then the sudden surge in the demand will cause the future price to rise above the spot price, so it will trade at a premium. So likewise, if a large number of future contracts are dumped in the market, which is basically the sell off comes, excess supply also will make the future price will go down. So it's like imbalance in the supply and demand will also impact the futures premium and the discount. So these are the reasons why the spot and future prices are not the same. Yeah, thanks.